All right. Howdy doody, folks. It is the Four Horsemen of Real Estate podcast. On this week's episode, we're going to be talking about Pierre Poilievre's announcement to scrap the GST on new housing. Along with that, we're going to talk about interest rates, how they're dropping, and I'm going to predict where I think that's going to go by the end of next year. We're going to get into a little bit of what that means in the economy as a whole, but also what that means for you as an investor. And that's this week's episode of the Four Horsemen of Real Estate.
I am announcing that a Pierre Poilievre-led common sense conservative government will axe the sales tax on new homes under $1 million. Getting rid of the GST on new home builds will stimulate 30,000 additional homes built every single year.
Pierre Poilievre looking to remove the GST. Look, at the end of the day, we know that the current program that's in place by the Liberals is not working at all. And so this very idea of cutting their program to be able to pay for it actually makes a whole lot of sense. Now, we know this. If you remove the price of the GST, does it make it more affordable? Absolutely. It does make it more affordable for people to buy the homes. Now, if it's cheaper, then it allows the builders to be able to sell more homes. But at the end of the day, what we really need to do to increase the sale of homes is to actually go back and get more houses built. I think that's ultimately the plan by Poilievre here, where he is trying to incentivize people to get in there and agree to buy the homes, which then incentivizes the developers to jump on in and start building those homes. Here's the part about interest rates. We're watching them coming down, and it's more than likely before the year is out that we'll see another half point deduction on the interest rate for homeowners that are looking to refinance. That's exciting. Except they've already announced that not only are they planning on doing another cut this year, they're planning on doing a few more cuts into next year, which means that a lot of homeowners are probably going to sit on the sideline trying to wait to get the lowest interest rate they can. And so we may not see the jump in the housing market in the spring like we may want to see. Well, here's the thing. Inflation has already gotten under 2% now, which, so we're told. Now, that's not all that difficult when you consider that rates went so high that people started backing up, started having to sell stuff, started having to just try to pay down debt to survive, and in many cases have not. We still have a backlog of foreclosures in the market. So as a result, we are watching deflation, disinflation. Disinflation is really the rate of inflation slowing down. We've now seen it slow down to 2%, below 2%, even though they're not announcing that we are in a recession right now. I think most people can feel it, can sense it, could probably tell you that it looks like we're in a recession. They'll, of course, announce that after we're past the point of being in a recession. So if that number has already retreated to 2% and has continued past that, I believe last month's numbers were 1.9. This month's numbers, again, will continue. It'll continue dropping until people are stimulated back in. So my prediction is we're going to have to see interest rates down at 1.9 just to balance this economy back out, to get that disinflation back to an inflationary state. Because you may or may not know this, but Canada and the world is all based off of inflationary economics, which means every country in the world prints more money, adds money to the money supply just to keep the entire economy not just locally, not just nationally, but of the world moving forward. Every country agrees to continue printing money. And when you're going backwards, like we are right now, a lot of bad things happen. If we ever get into the target or the range of deflation, then really bad things happen because you start to watch as markets completely implode. The last time we saw deflation kicking in was during the great financial, well, we saw a little bit of it during COVID, but the great financial crisis. And what did they do? They had to immediately inflate the money supply by trillions of dollars in the US, billions of dollars in Canada. And if we get into that territory, you will see as we start to print money, we start to create projects, raise the deficit, raise the national debt. It will come if people don't respond to the stimulus of lower interest rates. So my prediction is 1.9% will not be unheard of middle to end of next year. During COVID, basically the interest rate came down to zero. Now, having said that, there's if you were borrowing money, about the lowest that people were able to borrow money at was about 1.5%, 1.49, 1.4 if you were getting a mortgage. That happened during COVID. A lot of people were able to get interest rates on their real estate in the twos, 2.5, 2.3, quite common. We saw that during COVID, and we think, oh, we'll never see that again in our lifetime. We are on a precipice right now where that is very likely. It is quite likely, unless a couple of other things happen. One, if these wars continue, if wars escalate, oil prices continue to go up, that'll absolutely affect things. If they start printing more money, what do I mean when I say printing? Most of us don't understand that. If they start creating projects, if the government starts creating projects where it's going to spend billions of dollars on infrastructure projects, on building new hospitals, on all of this kind of stuff, and they don't have a way to pay for it, which means they instead borrow that money, which you and I are on the hook for. We have to pay for that debt, but they're still inflating the monetary system. They're still inflating our debt load. They could do that instead of lowering interest rates all the way down. One way or another, they're going to look for ways to expand our money supply to be in line with the deflation and to get it to come back up so that we are making sure that we have at least a 2% inflation rate. Now, they have to do whatever they have to do to get inflation at that level. If inflation isn't at that level, then what we have happen is trade deficits. We start having problems where our money is worth too much to be able to sell our soft lumber to the US, to sell products to other countries. And so the way to do that is to devalue our dollar. Now, if only one country devalues their dollar, then of course they go into high inflation and everyone says, oh, my money is worth so much more than yours. But for us, if our dollar does not get devalued in alongside the US, then our number one trade partner goes out the door. So we have to stay lockstep with them. As they lower rates, we have to lower rates just to stay in that trade balance so that we can afford to sell stuff into their market. Otherwise, we're left with a whole bunch of products with no one to buy. And that's the reason that we need to lower interest rates to keep up and to stimulate investment into housing, investment into businesses, investment into production so that we keep the economy moving, running forward, and growing alongside our trade partners.
Even the ones around trusting their word, they walk the talk in the world of investment. They make their mark.